Hi everybody, George Chamberlain here, watching your dollars on this Monday morning, the 8th of August. So I'm home Friday night. Been a heck of a week last week. The markets just got plummeted. Remember, it was a week ago that Congress approved and the President signed legislation to extend the debt ceiling here in the United States and also to come up with a plan to cut the budget deficit. It seems like it was months ago, doesn't it? But the markets didn't have a very good reaction to that. Last week, stock prices tumbled. And so I'm kind of at home Friday night saying, well, thank goodness this week is over. Just relax a little bit, watch some stuff on TV. And then all of a sudden I see this news breaking about Standard & Poor's lowering the rating on U.S. government securities from AAA, the highest rating, down one notch to AA+. Things went crazy on that. And by the way, kudos to Bloomberg TV. They did a masterful job of reporting that story immediately as it was breaking, unlike CNBC and some other business channels who were already into infomercial mode and didn't really cover it very well at all. Bloomberg was just spectacular all week long. If you have it on your cable at home, you ought to track it down and follow it. So anyway, we've downgraded the rating on U.S. Treasury securities. What does that mean to you? Well, it means obviously that the stock market is not liking it. We're watching stock prices fall in here again. And so your stock market portfolio, your 401k, could be taking a hit in here. And if you are a short-term investor, if retirement is a few months or a few years away, probably caution should have been advised a few weeks ago or maybe a few years ago if you're close to retirement. For the average Joe or Jane, you're going to stay the course. You're going to keep investing. Take advantage of these lower prices in here because if you're investing through a 401k or something like that, you're taking advantage of this sell-off. You're buying more of whatever mutual fund you were buying at a lower price right now, and over time that's going to certainly help you out, no doubt about that. Are we going to see interest rates go up as a result of this? I don't think so. We'll kind of have to wait and see how this works out over time. And it looks as though the one thing that's staying stable through all of this is interest rates. Actually, interest rates on Treasury securities have gone down a little bit rather than going up. That could all change rather quickly. But I think for the most part, things are remaining stable. There's a lot of emotions involved around this whole situation, and that's hard for any of us to avoid. You're wondering, what does this say about the overall economy? Nothing good. Standard & Poor's wants to see the deficit cut by $4 trillion. The government plan that was put out cut it by about $1.5 trillion, not nearly enough. And in all honesty, S&P had said up front, we're going to cut your rating if you don't deal with this stuff. So maybe this will force them. Could mean some higher taxes along the way for all of us. We're just going to have to wait and see how it works out. I would not get caught up too much in the emotions of this, but try to focus on just managing your own personal finances a little bit better as a result of all of this. Watching your dollars, I'm George Chamberlain. Have a good one.